Welcome to Talking Stocks. I'm Dumisha Greater, standing in for Gugulethu Cele. In studio with me, I have Sean, Ashton and Bryan from Anchor Capital. Today our conversation looks at FedEx, an American global courier delivery services company headquartered in Memphis, Tennessee. The name FedEx is an abbreviation of the name of the company's original air division, Federal Express, which was used from 1973 until 2000. Well, gentlemen, thank you so much. Before we start off with FedEx, Sean, maybe give us an overview of the divisions that make up this particular company.
Sure. So I think this is a big global courier services business, as you've mentioned. It's got an air freighting division, a land-based transport division. Operates in 200 countries around the world, but it's really an American-centric company. There's about 70% of their revenues or profits which come from the States, but quite a broad spread around the world.
Anything that you've got to add there with regards to the company?
No, as Sean rightly points out, this is a company that's got multiple divisions and also quite an extensive network. So although they may not necessarily have an express footprint in a certain country, etc., they do have the ability to link. So should you order something from Amazon in the US, it could potentially come off with FedEx to SA, DHL down to Cape Town, and then the courier guy to your front door, all within the FedEx network. So it's a very well-connected, well-networked business as well.
Let's start talking about the metrics of the particular company. Looking at that now, market cap, we're sitting at $47 billion US. Looking at its trailing of price to earning ratio, 17.7. Yes. Value for money?
I think so, yes. If we go and look at this business through time, its average long-term price earnings multiple, which we'll see a little bit later as well, sits at around 18 times. So trading at about a 17 is actually very attractively priced considering its long-term history. On a forward basis, coming down to a 15.5, which makes it even more attractive. They can have improvements around their margins, around their return on equity, but that return on equity is forecast to grow out from its current fairly low 6 or 7% through to the mid-late teens. So there is room for improvement within this business. They know that, they've seen it, and they're actually aggressively working towards improving those margins and those metrics.
Sean will pick up on the return on equity and what they're working towards, but maybe also tell us, why do you like this particular company?
So I think this business has demonstrated remarkable consistency of profit growth over time. And there's reasons to believe, as Bryan has rightly alluded to, that margins are going to grow in the years coming ahead. So a lot of that's going to come from further efficiency. So they've been undergoing a big fleet replacement exercise, which will result in greater efficiencies across the aircraft that they run. And at the same time, I think from a capital management point of view, they've got a fairly aggressive buyback program in place to actually reduce their share counts. Obviously, they're taking the view that they don't need to have as much capital as they have. I think last year they bought back something of the order of $4 to $5 billion worth of equity, worth of shares, and that's more or less 10% the current market cap. So we should be able to see this business reducing its share count by about 5% per annum, and that obviously adds to earnings growth because the interest drag that you have from that is very low in a low interest rate environment. So that's effectively a boost to earnings. So we think this business can probably continue to grow at 10 to 15% per annum, and you're not overpaying for that.
Bryan?
And just to add on to that, we've got a very good business here that, as Sean points out, from an earnings growth and a capital management. And then you've also got this macro theme of e-commerce coming on board, where somebody's got to deliver that package. You might order it online, but somebody's got to get it to you. They're rightly positioned to take advantage of that. You've seen global growth starting to tick up, bar a few incidences in the East and Europe of late, but the US continues to grow. And again, when global growth is there, these guys are going to take advantage of that as part of their growth strategy.
Bryan, let's just talk about those profit-enhancing initiatives. Anything else?
They've looked at from literally all the way down the income statement. So they're looking to restructure costs. They've really optimized their position, what divisions they need, what processes they need, what systems they need, all coming in from an expenses perspective. They've also then brought and spent money on capex to go and buy more fuel-efficient planes, more fuel-efficient vehicles, which has lessened their dependency on high oil prices or requiring low oil prices. So they've had a lot of initiatives that have been driven literally all the way down the income statement that's slowly but surely starting to add to that bottom line. And we've seen it, and we expect that to continue through to 2016. And the whole program is probably going to take out about $1.6 billion worth of costs out of the system, which is great for the business and adds to very much a good growth in earnings.
Bryan, future growth, where are we currently in terms of the revenue split, and how is this likely to change going forward?
I would imagine that the land-based, you may well see more growth in the e-commerce side of their business. So land-based delivery might well gain share as a proportion of the total. But I think when you're talking about e-commerce, you must remember that products are delivered across the chain. So I wouldn't expect to see a dramatic shift in internal market shares across the divisions. I think that all divisions will achieve relatively decent growth.
Yes. Wholeheartedly agree. You've got Express kind of makes up the majority of it at the moment, and that's really from a perspective of your fast overnight deliveries. I needed to be here at a specific point in time. So you're going to see this come through. Recent acquisition of T&T in Europe is really going to add to each division. So Sean rightly points out that seeing this revenue split, we don't really see it changing in favor of one division over another. You're going to see this harmonious growth across the entire business.
You clearly are very bullish on this particular company. Let's talk about other competitors in this particular market.
If we're looking from a US competitor and all the rest of it, UPS has to be the biggest, United Parcel Services. They, in essence, have a duopoly with FedEx in the US. There's certain areas where UPS is better, and there's certain areas where FedEx is better. But from an overall perspective, okay, this is a FedEx study, but they maintain their 30% of their business is faster than UPS. And only 3% of their business is at a disadvantage to UPS. So they really are driving the US market and want to be a leader. Taking that leadership role gives them the ability to have pricing power as well. So yeah, from a US competitor, that's where you sit. From a global competitor, you've got different regional ones. You had T&T in Europe, which they've recently acquired. And then as you go around the world, you'll find these smaller operations. Probably DHL will be the next biggest global competitor. But I think there's space for everybody in this world. I don't really see you going to have consolidation across the markets. I think it'll be opportunistic buying in order to take advantage of a market that's there. So I don't think we need to worry too much about competition from this business unless management puts a step wrong. If they manage to go backwards on margins or go backwards in that, then potentially there's somewhere for somebody to bring in the pricing power on that side.
Sean, what are the biggest risks to this business currently?
A global economic slowdown, and a dramatic one, because I think if trade in goods and services, and particularly retail goods and services, slows down, these guys are the delivery mechanism for a lot of that stuff. So, but I think it's that would have to be more concentrated in the US, given where their business is largely concentrated. And I think, if anything, we're probably a bit more positive on the US consumer. So while oil prices have come off significantly, there's a lot more money in the hands of American consumers, which can potentially be spent online, which would benefit their business from a delivery point of view. So I think a generalized sharp slowdown in consumption spend would be pretty bad for their business. But that's certainly not our central view at this point.
In terms of management, the people that are at the helm, are you seeing a lot of confidence from investors that this company is being steered in the right direction?
Very much so. This is a business that's had its ups and downs in its history, but the current management team really has instilled confidence and really driven this business and has been able to execute. I mentioned earlier about the cost-cutting plans and they've been able to do this in a very efficient manner. They haven't necessarily had to go and fire thousands of staff members. So they've really done things very efficiently. They've gained the confidence of the market, and we can see that in the share price movement that's come through in the last few years.
Gentlemen, we're going to pause our conversation for now, because now it's time for our experts to either buy, hold, or sell the stock. Right, Sean, buy, hold, or sell?
For me, it's a buy. I don't think it's necessarily the best business in the world, but it's a good business with a high market share in their industry, so it can continue to remain dominant. And you're not overpaying. I think this, in the context of global markets, any business delivering 10 to 15% earnings growth where you're paying a forward 15 PE, that sounds like reasonable value to me in this market.
Okay, so we've got a buy from you, and you did say things to take into consideration there is the global economy there.
Sure.
Okay, let's go to you, Bryan.
I'm going to reiterate Sean there on the buy recommendation. Sean points out from a multiples and a cost and a growth perspective, you're not overpaying for this business. And I really do think that, although not a big fancy business, not one of the tech businesses, not one of the ones that everybody's talking about right now, you've got a big global stable player that's managing to grow itself and enhance its earnings for shareholders.
Just a final question on that though, who would buy this particular company?
I think we're looking for people that are looking for a stable company that's going to give you good growth prospects and potentially that little bit extra. You know, the company doesn't pay dividends at the moment. It's got a very low payout ratio. They're using that cash to buy back shares, but at a point they're going to stop that. Then they're going to start increasing their dividends. So you've got somebody who's going to get capital growth through the process for now, and then potentially a yield income as the company gets bigger. So it applies to a number of clients, but currently not somebody looking for a yield or an income, somebody more looking for growth.
Anything you want to add to that?
I think that summed it up pretty well.
Thank you so much, gentlemen. Of course, you're telling us about FedEx, the fact that they are a global player. When it comes to competition in that particular market, you did say it was UPS, but you did say they do have varying positions. Yes. You do have faith in its management company, and of course, when it comes to risks, we are looking at the global landscape being one to take into account. I'm afraid that's all we have time for this week. A big thank you to Bryan, to Sean, Ashton, and Bryan from Anchor Capital. Do make sure that you catch us next week, same time. Have a great day.